Hi, welcome back. Thanks for tuning in to another episode of the Rentvesting Podcast. Now, what are your thoughts on robots investing on your behalf? What about if they were specifically targeting ethical investments? Well, this is actually the reality that Emily Martin from Balanced Impact has created. Now, Emily, for 15 years, she worked in high finance across all the major markets, Sydney, London, New York, and managed and monitored, major ethical and mainstream investment portfolios. And it was through this accumulation of experience that led Emily to establish Balanced Impact. And more recently, I was fortunate enough to have the opportunity to sit down and chat with her directly and hear all about it. So, let's get to it. Emily, welcome to the Rentvesting Podcast. It's great to have you on the show.
Thanks, Pete. It's nice to be here.
Very good. Look, I've been really intrigued to actually have this conversation with you because I have to admit it's an area of the investment opportunities that I don't know an awful lot about because you're quite on the cutting edge. Mm-hmm. So perhaps a good thing might be to start off is if you just give our listeners just a bit of a background on yourself and what your business is all about.
Mm-hmm. Okay, sure. So I've worked in investment management for the last 15 years. I've worked mainly at investment banks. I worked there for around 10 years. And it got to a point where I just wasn't that interested in working for investment banks and making more and more money for the banks themselves. And I thought there must be something more positive I can do with finance. But I did really love investing. So I thought, well, what can I do that involves investing but has something a little bit more meaningful than just generating profit for large banks? And so then I moved into impact investing, which is a kind of ethical investing. And essentially what that's all about is investing in companies that make you money, but that also have some positive social impact. So that might be things like renewable energy or microfinance, where you're providing loans to people that previously haven't had access to any banking services. And once I moved into that area, I was still managing funds, but I was mainly managing funds for high net worth individuals. And so I worked in that area for around 5 years. And then it kind of occurred to me that, if there's, for the average person, like the average mum and dad, there's not a lot of opportunities to invest ethically because most of the investments are only available to ultra high net worth, so minimum investment size.
And why is that the case? Just because of the way that the products have actually been created by these institutions, or?
Yeah, that's right. It's kind of hard to sell to retail investors because you need to have certain documentation in place. So you have to put out a product disclosure statement. You have to address all the risks. You have to have a license that allows you to sell to retail investors. And also, if you're raising a fund of $100 million, it's much easier to get people that are investing
lots or
over $1 million.
Yeah. As opposed to...
Exactly, rather than go out and try and find thousands of people who are going to invest $1,000. Yeah, so I thought, well, what could I do that would give people access to ethical investments, but in a way that gets around some of those issues? And I spent the last few years working in New York, and there I was focusing a little bit on fintech. And I got quite interested in robo-advice, which is essentially online investment advice. And one of the things I liked about it is that you can provide high quality investment advice to a number of people at low cost. And so I thought, well, this is a really good way to provide ethical investment advice in a low cost, scalable framework so that it is possible to provide it to retail investors. And it gets around some of those previous issues of the difficulties of managing large number of people with small size because you can do it electronically. So that's kind of what I'm doing, setting up an ethical robo-advice service.
Extra cool what you're doing. And so unique in terms of the offering. And so applying out of the box thinking to bring something that people are more and more moving towards. And I think probably more on the ethical investment side, or being more conscious and aware of where their funds and perhaps their superannuation funds are invested in, and that they are actually making a difference as well. What type of percentage or could you wrap some figures or facts around the uptake of people that are moving towards ethical investments, or even people that are actually becoming more reliant on robo-advice?
Sure. I mean, both of them, so the ethical investing and the robo-advice are two big growth areas. Start first with ethical investing. There's an organisation called the Responsible Investment Association of Australasia, and every year they do a report called the Benchmark Report, where they look at trends in responsible investing. And they found that over the last 2 years, the amount of funds going into responsible investing has doubled. Yeah, so it was in 2013, it was around 26 billion, and now it's around 52 billion.
Did they give an explanation as to why there was such a significant jump?
They said it's mainly been driven, interestingly, by retail demand, so consumer demand. And it's hard to say what it is. I think people are just becoming more aware that their investments could be going into areas that perhaps they don't agree with. Whereas I guess there's a focus more on the financial transparency within the financial sector. So people want to know where their super's invested, what's happening with it, where their other funds are invested and what's happening with it, rather than just giving it to a fund manager and trusting that it'll all be good. So I think with the increase in transparency, people are aware that, wow, my funds were being invested in tobacco or in fossil fuels. And they don't want that to be the case. So then they're going and seeking out funds that avoid those industries. It's still quite a small percentage at the moment. It's around 4% of total assets under management. But as I said, it is growing. And in terms of the robo-advice sector, that's really very new. The market started mainly in the US about 4 or 5 years ago. And since then there's been, I can't remember what the total numbers are, but there's been billions of dollars going into it, and it's forecast to keep growing at a very, very strong rate. And the reason I think it appeals to people, particularly people with smaller assets under management, is that instead of paying the high fees of going to see a financial planner, and financial planners in themselves aren't actually investment managers. They're good at financial planning. That doesn't necessarily mean they can manage money. So instead of paying the fees to go to and see someone in person, people now have the ability to just go online and access a low-cost service that's managed by professional investment managers. So that's seen a really large growth in robo-advice.
How advanced is the technology at this stage?
It's fairly varied. So in the US, it's the most advanced. So in the US, they do things which you can't actually do in Australia called tax loss harvesting, where if your shares go down, they will sell them and buy them back immediately so that you lock in a capital loss, which will then offset your capital gain. And so this could happen many, many, many times a day. So they have very sophisticated models that are trying to maximise your return through tax loss harvesting. And they're also trying to continually rebalance your portfolio and optimise the risk-return metrics. In Australia, the technology is not as advanced. So generally what happens is you'll go online, you'll answer some questions about your risk profile and how long you're investing for, and then you'll be allocated one of 5 investment portfolios from the least risky to the most risky. And then the investment will happen basically automatically, so all online, and your portfolio will be monitored and potentially rebalanced. But it's not the same high-tech algorithm that's continually buying and selling and rebalancing your portfolio.
Is it something, though, in terms of the actual advice piece, would it be something that would get better in time through the machine learning algorithms that are applied in terms of the more data that you're feeding these machines and the different behaviors of investors that are coming through? Will they be intelligent to pick better options as a coming of age, or?
Yeah, I think there is more a push to start using artificial intelligence, but particularly around the behaviour of investors, because they found that
take the emotion
unfortunately
out, or?
Investors are exactly they're kind of their own worst enemy. So people panic and sell when the market's down, and there's been a lot of studies done that show you can't time the market. So the whole buy low, sell high, no one could do that. And so the studies show that you're just better off generally staying in the market. And what happened after Trump got in is a big example. The day he got in, the markets fell and some people panicked and sold, but the next day the markets were up 10%. So instead of trying to time the market and figure out what it's doing, you're better off staying in. So there is work being done at the moment around artificial intelligence trying to predict when people might panic. And then communicate with them and say, hey, look, we know, for example, Donald Trump got in and there's a lot of uncertainty, but let's just wait and see what happens before we go out and sell all our shares. Exactly.
I'd imagine the school of thought behind that would be bringing some more consistency to markets and ultimately some better returns for investors.
Well, that's right. Yeah, it really is about getting better returns for the investors. So there is work being done in those areas. But I think you're right that the robo-advice market will become more and more sophisticated. And the investment aspect that I've been talking about is just one part of the robo-advice market. There are also other areas where you could go on and get advice about, your retirement savings, or there's also talk now about mortgage broking happening online. So there are lots of different areas where the same concept of providing standardized advice online could be growing.
From a regulatory perspective, what are the government's thoughts around this in terms of moving to this more technological driven model?
Well, the regulators have considered it. So ASIC put out a paper recently, and one of the concerns they had was that if the models were driven just purely by technology, then is there anyone there that is sense checking the models? So now they're saying that they do need to have an actual person there continually monitoring the models to make sure that what they're putting out is sensible. And to provide this advice, you do need a financial services license, the same way that you would to provide any other kind of advice. So I think in Australia it's going to be regulated in a similar way to other areas of investment advice. And the UK has taken a similar approach to Australia in that it's quite well regulated. In the US, they have, I guess from the robo-advice perspective, they have a bit of an advantage in that some of the biggest robo-advisors, so one of the ones that started first is called Betterment. And when you go online to sign up, you basically just answer 3 questions. You say what your age is, how much you earn, and whether or not you're still working or you're retired. And then they give you investment advice.
Simple as that.
Yes. So it's great because they say you can sign up within a minute, and that's really good. Whereas in Australia, you're going to go through a more rigorous process because ASIC says you need to act in the best interests of your client, and you need to have an understanding of their financial situation to do that. And so generally the robo-advisors, just like a financial planner, will need to ask you questions about how much money you're investing, what proportion of your total net wealth is that, how long do you want to invest it for, how do you feel about risk, do you want to maximise your risk, or are you worried about losing money, so therefore you prefer to minimise return. So there's a lot more rigour around the provision of advice in Australia.
And do you think that would affect the adoption of the technology into a more wider base, or is there a reluctance perhaps from the average investor, myself and colleagues, just average Joes, using this sort of mechanism?
Well, I think it's definitely easier in the US because you can sign up in a minute, whereas in Australia it'll take you 10 or 15 minutes. But, I mean, the focus, at least for myself, is on providing ethical advice. And the ethical advice is not just in terms of ethical investments, it's also making sure the products that are sold are appropriate for the person who's buying them. So, for example, some of the US robo-advisors, they say if you want to save for something, you can save through their platform. But I don't think you should be investing your savings in the stock market if it's for, a short term. Generally, you're investing in the stock market, you should be investing with a time horizon of at least 5 years. And so I think the questions and the process that ASIC makes investors go through is actually better. And if it does deter some people, then that might be a good thing because the service might not be appropriate.
They would elect out of the process or naturally elect out of the process themselves. Okay. Yeah.
That's right.
If I was to sign up through Balanced Impact and go through the process, the questions that I would be answering would then dictate the recommendations of the investments or the ethical investments that are ultimately selected?
That's right, yeah. So there'll be 6 portfolios. So the 5 take you from different risk, from really low risk to high risk. And the main difference between those investment portfolios is that a lower risk portfolio will contain more bonds and cash and less equity, whereas a higher risk portfolio would contain more equities and particularly more international equities. And then there's also a 6th portfolio which is focused on self-managed super funds, and the focus of that portfolio is generating income.
Okay. And typically what sort of investments would be in these funds from an equities perspective? What type of companies would they be?
So it's going to be investing in exchange-traded funds. So, for example, in the Australian market, there are some ethical exchange-traded funds that provide access to Australian companies that are not involved in fossil fuels or tobacco or gambling. And then there's also an international ETF or a couple of international ETFs, one of which that I intend to use is focused on the United Nations Sustainable Development Goals. So that targets global companies that are generating at least 50% of their revenues from the United Nations Sustainable Development Goals. And that's things like making sure everyone has access to clean water, that they're not living in poverty, that they have access to education. So there's some of the broad themes of the goals. And then the companies that exchange-traded funds invest in, they're actually out there achieving those goals.
And is there a minimum investment amount to access the funds?
It's $5,000.
Cool. Sounds pretty reasonable. And
it's just hard to minimise the fees because the whole purpose of robo-advice is low fees. But there's a certain threshold that you can't really get below. So I'd like to be able to offer it even less than $5,000, but it means the fees would be, a few percent of someone's
disproportionate
high as a percent.
The juice wouldn't be worth the squeeze in doing the process, I guess. Yeah.
Exactly. I mean, there are some other people out there offering robo-advice in a very, where you can, just put in a couple of dollars a month or something, but I haven't figured out how that works in terms of your return and the fees you pay. I suspect you're paying like 50% of your returns in fees or something. So I didn't want to do that. Hence it's like $5,000.
So how can people find out more about Balanced Impact then?
Just going online to balanceimpact.com.au. So at the moment, we've just got the landing page there, but we'll be launching next year. So all the technology is being built now.
When will the launch be, roughly speaking?
Definitely by the beginning of next financial year. So that's when we're targeting. So 1st of July, next financial year.
Well, it's great to have you on the show. Thank you very much for giving up your time and talking to our listeners here, Emily. And look, I'll put up your web address as well, so our listeners can check that out, and look forward to hearing how the launch goes and seeing what takes place in this space over the next 12, 18 months or more.
Great, yeah, I think it's a pretty exciting time, and there's going to be a lot of new developments in finance that should benefit the consumer.
Emily, thanks for coming on. Appreciate it. Bye-bye.
All right, thanks, Pete. Bye.
That wraps up another episode of the Rentvesting Podcast. Now, after you leave, be sure to check out balancedimpact.com.au, and if you're yet to do so, also visit the free resources section at rentvesting.com.au. We're both aiming to deliver major value for you. So thanks for tuning in, and until next time, bye-bye.